Now, those journal entries represent the transaction of just one salt lamp. But how would Summer and Sophia account for many at one time? For that, they'll need to set up an inventory system. There are basically two: perpetual and periodic. Remember our basic definition of inventory? The stuff held by a business with the intent to sell it to earn revenue. With a perpetual inventory system, the inventory account is continuously or perpetually updated to account for inventory as stuff is bought and sold. On the other hand, a periodic system updates the inventory account only at regular intervals, such as at the end of an accounting period. Perpetual systems are pretty handy because they help you track your inventory in almost real time, which means you can see things like where your inventory levels are at. On the other hand, a perpetual system could be more costly to set up for a small business like Summer and Sophia's. A periodic system is much simpler, which makes it less of a hassle to set up. With a periodic system, however, you lose that real-time view of your inventory since you are only checking it at specified intervals. This makes it much more difficult to know what's going on in between your inventory counts. Let's hear more about these systems from our experts.
We're going to talk a little bit about perpetual versus periodic inventory. Now, inventory, of course, is when a business owns assets that it is going to sell and earn revenue from. And the question here is, when do the costs of that asset get recorded against those sales? So a perpetual inventory is when a sale happens and the cost of that item, the amount that's in the inventory asset account, is immediately expensed as what we call cost of goods sold. When you are doing a periodic system of inventory, then it happens on a frequent, regular basis, but not necessarily or not at all at the time that the actual sale takes place. So depending on the type of company it is and the amount of inventory and sales that they have, the smaller the organization, the more likely they are to be using a periodic inventory calculation where they do it quarterly or in some cases even just annually, where they determine how much inventory they've produced minus how much they have left at the end of the year, would tell them what their sales are, and that amount there would be your cost of goods sold there, the difference between your beginning and your ending inventory, and your purchases, of course. So with a perpetual system, there is typically going to be an automated inventory system that is going to calculate that for the client, allowing them to have the sale and the cost of sale booked immediately all throughout the year. Now, a perpetual inventory system will still do an inventory count at some point, but typically on a frequent basis, they would adjust that inventory based on any type of what they call inventory shrinkage that could happen, where something gets damaged or destroyed or lost or whatever the case might be. But the ongoing regular maintenance of that costing is happening on a perpetual system is what typically would happen.